Okay, so in this section, I'm going to be talking about what is a FICO score, what does your FICO score mean, and then I'm going to switch to another slide inside of this same video, and I'm going to show you how your FICO score is calculated. So when it comes to your credit score, let's just talk about just the credit score itself, right? The credit score is a 3-digit number that is used by lenders to determine your risk. And there are different scoring models out there, and FICO is the main scoring method in which lenders use to lend money. Okay. There are other scores out there, and I hear people say, well, Credit Karma is not right or incorrect. No, it is correct, but it's just a different scoring model. So that's why your FICO score and your Credit Karma may be off. And so when it comes to lending, you want to, go with your FICO. But at this particular point, we're not going to deal with the difference between the models, because that really doesn't matter if you still have negative derogatory information on your credit or you don't have positive trade lines. And in this course, I'm going to get you there. I promise you. That is my promise. Listen, and if you are in the poor section, the 300 to 579 section here to the right, listen, don't worry. I used to be in the 500s. Okay. I didn't always have good credit. And that's why I educated myself on these, on financing and credit, because my love for it came from the fact my credit got shot and I was like stuck, and I wanted to flip houses and I couldn't do it because I could not get the financing. And I took a year. It took about 9 months to really get there. And I just continued that journey. But I went from 500s to 700s. I started flipping properties in the mid 2000s, right up until the market crashed. I was flipping houses. Okay. So you're talking to someone who's been there. All right. And I have the knowledge, and you're going to see through this course, you're going to be able to get the results. You just have to trust the process. Okay. Remember, this is a marathon. This is not a sprint. All right. So why do lenders use this score? They use the score because the score helps them to determine, or it actually calculates the risk. So basically, the score calculates your likelihood to default on a loan within the first 90 days or within 24 months. Okay. Now, if you are in the 300 to 579, you're going to see, I'm just going to read. It says a score in this category may require borrowers to pay deposits or make larger payments on their homes than other borrowers. And that's across the board. So it's not just for homes, but in all scenarios, when you are in this particular section, the 300 to 579, just know that you're going to pay higher interest rates. You're going to pay higher deposit. The higher the risk, the higher the deposit, and the higher interest rate. Okay. And so, I want to, throughout this course, I'm going to be talking about mindset, because I've worked with thousands of business owners over the last 17 years. And when I say thousands, I literally mean thousands. That's no exaggeration. And this course is mainly designed. So I designed this course so that I can help people go from the very poor section to the exceptional section. Right? Why would I do that? Because owning a finance consulting company, it makes sense. If I want more borrowers, then I need to help you go from that section to a borrow, or what we call a lender friendly profile. And so that's the whole goal of this, is to help you finance that vehicle, your dream vehicle, or to start the company that you need, or if you already own your company or you're trying to start a business, you will be able to utilize the tools that I'm making available to you to get unlimited amounts of financing for your business. Okay. And so that's the whole premise. So let's look at 580 to 669. If you're in this section, that means that lenders considered you, to be subprime, and you may face slightly higher rates when it comes to borrowing money. That's not a may, you will. Okay. And the reason why I'm saying this is because mindset is everything, ladies and gentlemen. And I have some borrowers that come to me and their credit, they don't even know their credit, or their credit is, poor. And when I say this, I'm saying this as delicate as possible, because when I share my story, I want you to know that I was right there with you. I'm saying that to say I'm not picking on you, and I'm congratulating you, because if you're listening to my voice, you're taking the right steps. But I also have to talk about mindset for some individuals. It might not be you, but some individuals. If you are looking for a loan from any lending institution, if they give you a high rate, it's not their fault. Okay? It's not the loan officer's fault. There's so many times where I'm dealing with a client and they have a very poor credit, meaning that they're a high risk to the lender. Mind you, I have lenders that will lend you money. Okay. I can get it done. All right. That's not the issue, but just know if you're getting a loan and you haven't went through the process, I can get you the money, but don't complain if it's a little higher. Now, I have people that take the money and say, hey, I know it's going to be higher, and I don't care, because guess what? I'm going to make more money off of the money that I borrow anyway. For example, I had a guy, he added a bay unto his, he have a auto shop. I always use this example because it stands out to me. This was several years ago, but he owned a auto shop. And he wanted to expand his base so that he can help more clients. And when he got the loan, I told him, I said, hey, the rate is not going to be favorable. It's going to be expensive. It's going to be high, because I'm straight up. I don't, when I'm dealing with you, you're going to realize, even if you decide to work with me or the team, we are very straight up and honest. If you come and your ducks are not in a row, we can get you the money, but don't expect to get the same rate as a person that have ducks in a row. Or if you're just starting a business, or you've been in business for 3 months or a year, you can't expect the same rates and the same programs to be available as someone who has an excellent credit score. They've been in business for 5 years and they've been paying their bills on time for the last 30 years. You just can't expect the same thing. So each one of our journeys is different, but don't worry, I can get you done. So what happened with this guy, he added the bay into his auto shop. And when he added the bay, guess what? His numbers doubled, because he was able to see twice as many clients. His customer service and customer experience went up because people didn't have to wait in line as much. And he ended up getting another loan. We helped him out, worked on his credit in the process. In the second, and within 9 months, he was able to refinance everything to a lower rate, and so on and so forth. So just kind of let you know how these things work. So now if we go to the 670 to 739, that's good. And if you're in this range, you're in a decent range. Definitely 720 north of 720, I would say. 700 to 720 is where, it start looking really, really good. But we still can get great rates in this particular section. Okay. Even in the 600s, we can get, decent rates. All right. So anyway, in this section, you'll start getting, some better rates. Everything will start looking good. You'll be able to probably get into some loans with no money down, and just all kinds of doors open up to you, and different lenders open up to you, because we have lenders that only lend to people that have a 650 or higher credit. We have some lenders that only lend to people who have a 680 or higher. See, every notch that you go up, what happens is just open up the door to more lenders. That's all that's happening. So the lower you are on the totem pole doesn't mean we can't get you done. It just means that you don't have as many options. And that's what this is all about, ladies and gentlemen, making sure that you get your score right so that you have the best options available to you. So you can read those other ones. I'm sure you've already read it. So I'm going to just go ahead and jump over into how we calculate these scores. Okay. How is your FICO score calculated? Number one, if you look at the bottom section, 35%, ding, 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 ding. Payment history is weighing in as the heavyweight. If you got great payment history, it's going to show up heavy and it's going to represent you and boost your score up. If you have some late pays or some derogatory accounts, that's what's pulling your score down. And obviously, if you're here, that's the issue. And guess what? We're going to knock those babies out. We're going to get them off we're going to work to get them off of your report. And guess what? When you start removing those negative items within the next month or so, what's going to happen for you is your score is going to shoot up. Okay. And while we're getting rid of negatives, I'm also going to be showing you how to add positives as we go as well. So all of that is going to be working in your advantage. All right. But 35% is your actual payment history. 30% is the amount owed. So 30% of your actual score is the amount that you owe. Okay. And that just means how much do you owe on the available credit that you have. And a lot of times you'll hear, or if you have credit cards, you'll notice if you use your cards and your balances are high or what have you, it can drop your score as much, I don't know the exact amount because I've seen different numbers, but I mean, it can drop your score 60 points overnight if your credit card balances are too high. Now, most people say keep it under 30%, but I like to tell people you want to keep your credit card balances, around the 9% range, if possible. You want to be around 9%, not 30%. I know you hear that out there, but listen, I'm telling you, I underwrite loans. So I'm just telling you, but let me say this, if you're in a position where your cards, let's say your cards are, your balances are high on your cards, there are several ways in which we can help you kind of get around that. One way is asking for a balance increase. Another way, I'm not going to get in. We're not in that section. You can tell I'm on go. And throughout this training, I may just jump and dive deep into showing you an advanced tactic, and I'm only supposed to be giving you some basic knowledge. But just know, I want you to know, if you're in that situation, I'm saying it, but don't feel discouraged because we can help you out. Okay. All right. Length of credit history, how long you've been using credit. This is really heavy, because you're going to notice throughout the process, what'll happen is your score throughout your credit optimization repair process, your scores are going to go up and down. Your scores may even drop during this process. You may say, why? Don't worry about that. It's going to shoot right back up. That's just normal throughout the process. But sometimes what happens is, let's say you have a derogatory account and it's 20 years old and it's giving you a large payment history, because that's a long payment history. That's really, really good. And you get it taken off of your credit report because it's a derogatory, then it may shrink that payment history and it may actually make your score go down a bit in that instance. Okay. But don't worry about it. We're gonna get them off. We want it off because there's ways to build history, and I'll be showing you how to do that as well. Okay. Types of credit used. So with your mixed credit cards, retail cards, it's something about the way this credit score algorithm is actually rewards you for getting more credit. It's like, okay, and what I mean by that, you see where it says your credit mix. What the credit bureaus or the scoring model want to know is how responsible you are with different types of debt, right? Because you might be really good with installment loans, like a car loan, right? We have people that, you may pay your car loan on time, or your mortgage, or just if you took out a finance loan, that's an installment loan. An installment loan is you take out a certain amount of money up front and you pay a specific monthly payment. All right. So you may be good at that, but then you may not be good on your revolving accounts. Your revolving accounts includes your credit cards or line of credits. And those are accounts that fluctuate every month. The balance, it may be at zero and you don't have to pay anything, or it may be at $100 and you may have to pay a small payment. That's accounts that fluctuate. You may be really good at that, but poor on your installments or whatever. So all in all, the reason why the credit mix is important is just to see how responsible you are with different types of debt. Okay. Now let's talk about new credit. This is how much new credit you're taking out.